they're at a certain age and they plan to keep the home, wouldn't it make more sense if they actually increase the payment on their mortgage? That's how we're converting people right now on rate and terms. We're actually selling them into 15-year fix, even though it's at 4.25 or 4.5, because it's in line with their storyline. It's not ours, right? We're not making the decision based on our view, right? We're making the decision based on their view. So if their goal is to pay the house off and leave it to their kids, we then hit certain pressure points, right? Like, you don't want to leave your grandkids or your trust with a debt to hold on their shoulders, right? You want to leave them with an asset. Last thing you want to do is leave them with a 30-year mortgage that they got to now take on as another expense. With regards to like financial pain, when we deal with prospects, it can't be from your perception. What I mean by that is when you go into a situation and you're qualifying it based on your pocket, based on your perception of what you believe is a sellable deal, you're going at it wrong, right? What you have to do is actually figure out the perception of the prospect themselves. And so, the value of $100 between you and me is very different. Does that make sense? The value of $200 savings per month or $50 savings per month, it hits different to us, or me in particular, because I live in Southern California. But if I'm talking to someone in a rural state, that could very well much mean 10% of their income. But oftentimes what we forget about is the surge of cash flow that they get with the transaction. And what I mean by the surge of cash flow is, like the payment deferral, right? Not only on the mortgage, but any debts we might be paying off. Are you adding that up? Do you have the calculation on how much escrow balance refund they're going to get? You ever think about that? You ever look at the difference between, Freddie, right? Freddie can go up to 2% or 1% of the loan amount, or $4,000, whichever's higher, or versus DU, right? That can go up to $19.99 cash to them and still call it rate term. So if they come across a surge of cash flows of like, let's say $7,000, and they could pay off 4 cards, that now turns your $15 savings into $615 savings. Wouldn't that make sense? But a lot of us, we forget that, we overlook that, because our focus is the result. Our focus is, hey, I got an option for you, right? Here's a 30-year fix. It's 5.25. It's going to cost you 3 points. I know you got a 2.25 now, and then you start shooting off the benefit. That's a wrong way to go about it, because you need to be more engaged with regards to what they're trying to do. And so if we definitely do, we come across a lot of people who are financially secure, right? So you might be an LO that, immediately you're looking for pain. But in your perception, that pain means debt. That pain means that you are living check to check, or you have a lot of debt, because otherwise, why would I refinance you? You have to change that construct. You have to change that perception, because even though they got a 2.25, right, we have to look at other factors. So for example, one thing in my script, if you don't have a copy, by the way, go to salesremastered.com, you get a copy. I talk a lot about net, right? And so if we come across a homeowner who says they have no debt and their net is 5,000, and we ask them, okay, if your net's 5,000, how much are you adding to checking and savings per month? And they say, I'm adding, 3,000 or 5,000 per month. What's the balance? I got $180,000. Okay, then ask them, is it growing or is it staying the same? If they say it's staying the same, they don't really got cash flow. Does that make sense? But if it's growing, then we ask them, we say, okay, well, are you parking all your money in savings, or are you redirecting it into IRAs, into stocks, right? And the reason why this is important is because we have to understand the reason why they're parking money is to hopefully get a return. They're trying to make their money work for them. So you're going to come across a lot of people who play stocks, who park their money in IRAs. But when you actually do the research, stocks are down, so they're in the red. Whereas like IRAs, the max return is probably like 5-7% if you got a real good, financial manager and you know what you're doing. Whereas real estate, if you park your money in real estate, you got at least 8 to 10, some areas are like 15% upside. So the goal is to know that if they're parking 180 grand in their bank and their bank is only paying them 25 basis points, would it make more sense to actually park that money in real estate? And so now we look at other things, like how old are they? What's the intent for the home? And you might come across people who, did a refinance last year into a 30-year fixed, but they're 50 years old, right? maybe 60 sometimes. And they are financially stable, but they're parking money in an account that's actually losing value. Which are those accounts? It's a savings account, because a savings account is not keeping up with inflation, nor is IRA or stocks. So if they have so much overflow with regards to their cash, and they're at a certain age and they plan to keep the home, wouldn't it make more sense if they actually increase the payment on their mortgage? That's how we're converting people right now on rate and terms. We're actually selling them into 15-year fix, even though it's at 4.25 or 4.5, because it's in line with their storyline. It's not ours, right? We're not making the decision based on our view, right? We're making the decision based on their view. So if their goal is to pay the house off and leave it to their kids, we then hit certain pressure points, right? Like, you don't want to leave your grandkids or your trust with a debt to hold on their shoulders, right? You want to leave them with an asset. Last thing you want to do is leave them with a 30-year mortgage that they got to now take on as another expense. And so I think that's something that, you really need to open your eyes to, because if they're putting $5,000 every month into their bank, but their bank is only giving them 40 basis points to hold it there, whereas inflation is upwards to 8% or 9%, they're losing money. Whereas real estate, if they parked it in real estate, it's actually outpacing inflation. So now we got to be creative and not just dump all that information to them. We actually then have to maneuver and say, okay, well, you're on a 30-year fix. You do plan to pay this off. You're 50. I imagine you're not going to work past 65, or the goal is to retire at 65, right? Yeah. So if I can show you how to pay this off in 15 years, what's a comfortable payment for you that you can make? And they might say, like, maybe $200 extra. But wait, you got $5,000 that you're putting into a bank account. Like, you can only afford $200 more. That $5,000 is losing value. Where if you parked it in real estate, you're not spending it, you're just parking it there. Would that not make more sense? And then they're going to tell you, yeah, that makes more sense. Okay, now how much can you afford? Well, if you put it that way, I could send an extra $2,000 on top of my mortgage. What we just figured out is how much they can afford. And so now we can show them how to do a 15-year or 10-year term. You get it? So it's not about the rate or the fees. It's all a matter of how they plan to deal with the property. And if they plan to sell the property, it's a different story. Now it's a matter of doing a cash out for home improvements to make sure that they get top dollar value.